So just some news coming from our ecosystem and various headlines. From the ecosystem, we have some good things happening with the Lynx wallet. Their latest release integrates an on-ramp solution to their app that allows users to directly buy KDA. So it's always good when there's more ways to get KDA. So that's exciting. And then Unit is an interesting SocialFi app rewarding users for consuming content. They launched their mobile app on major, on Apple and Google mobile platforms. And this has also been a chance for us to lean in on co-marketing. We've added a Kadena user profile for others to follow content and to help influence new users join. So come check it out. It's an exciting new app on the Kadena blockchain. So some headlines. We have you might recall that our Kinesis bridge, we've been doing a bounty program to get hackers to come in and try to hack the bridge. Initially, we dangled 20,000 KDA, and that was claimed by a researcher who came through and we were able to fix a very important bug in the Kinesis bridge. We were launched with 40,000 KDA, and it was not claimed. So that's good news. We're all clear for formal launch of the Kinesis bridge later this month, which, to remind people, that'll be the first time that there'll be a fully supported bridge to Ethereum, and other ecosystems will be coming through Kinesis soon after that. But initially, it's for EVM and for moving KDA into DEXs, and just making it once again easier for everyone to get KDA and be part of this action. Some events. There was the GBBC in Washington D.C. We had our BD team attending. Our CBO Annalise Osborne was there to speak with policymakers and legislators about blockchain. We went to Istanbul Blockchain Week in IBW 2025. I presented there about our upcoming Chainweb EVM testnet, and we got to connect with the Turkish community, which was really great because Turkey crypto folks have been a big part of the Kadena story ever since we launched. So that was really great to go there and actually, meet in person. Including we had a rooftop bar meetup for local community members, and in general, it was really great. And then we went to Cannes for ECC, and that was where we unveiled the Chainweb EVM testnet. This was a huge hit. We got so much interest at the booth. I spoke, and the crowd response was great. We have 200 plus developers, more than 50 committed projects. We launched 5 new EVM testnet chains, and the enthusiasm at the conference and the interest. I mean, it's just so clear that we're providing something that people haven't seen before in the Ethereum EVM world. Both the fact that we've got such a compelling solution surrounding parallel chains and, dealing with gas problems and congestion and just making that go away forever. But also there was a lot of interest in the fact that Kadena is a proof of work chain. I think the dominance of proof of stake, the kind of overwhelming amount of proof of stake projects has really made people get much more sophisticated about proof of stake. And as a result, they see some of the issues that come along with everything from centralization to just the kind of risks that happen when you have something like, a restaking protocol that can take over the majority of the staking liquidity and things like that. The simplicity and proven security of proof of work was very much of interest to people at the conference, and so that was super exciting. So along those lines, we released a dev portal page for the EVM effort. You can find it at evm.kadena.io. And it's where it has developer resources and what projects are deploying on testnet and so much more. And then other than that, there's been a lot of appearances and marketing communication efforts with our executive team and BD team members, interviews and podcasts. recent articles in Blockworks and Forbes. I was on Turkish live TV, which was kind of fun. That just came out, but it's completely in Turkish, so I have no idea what we're talking about anymore, but that was nonetheless really fun. So, all right, so that's the news. I think we have Nitin, is that correct? Nitin right there?
So I'm here, Stuart. Really good to be here.
Great.
Always excited talking about Kadena and what you're doing. So thanks for having me.
Yeah, well, I'm super excited. Nitin is an advisor who just has so much depth in, today we're going to be talking about institutional adoption in RWAs and, and what some of the recent changes to the Kadena offering means for that. But Nitin is just one of the deepest thinkers I know surrounding this entire space. He's just a super impressive thinker, and he's involved with lots of really exciting projects. So we're really glad to have him as an advisor at Kadena. And I'm personally really excited to be talking about some of this stuff because I always learn so much when I have a conversation with Nitin. You guys are really there's gonna be lots of really interesting things to talk about today. So let's get going. I think, the question that's on everybody's mind is, it's really exciting how tokenization of RWAs and, the first question is really, and specifically RWAs on public chain. I mean, there's lots of interesting things going on with people using permission chains and things like that, but we've clearly seen this huge explosion of activity, interest, adoption, innovation, using public chain for RWA. So then the big question is the infrastructure ready for institutions to truly use public blockchain?
No, so first of all, Stu, thanks for including me in this call, and thanks for the kind words. It's an interesting conversation to have this week because this week you have something called a crypto sort of week in DC. Few regulatory sort of things, and I think Annalisa is on her way to be in the middle of that conversation. But I would say that the market today is going through this structural shift, right, driven by institutional interest. Largely, the maturing infrastructure as we have seen this evolve, and we'll spend some time talking about that, and the regulatory signals that are increasing favorable, situation, especially in the US at the moment. So there are three sort of, to me, to answer your question, broad areas that are characterized by one, productionization of blockchain-based financial instruments. So these are things like ETFs, money market funds, even though many of them are wrappers, so to speak, which means that they are taking these digital assets and crypto assets and wrapping them into traditional sort of market infrastructure and the instruments that the financial industry is used to, it still gives an edge up to the industry in general. And second thing, I think that's a primary driver is an increased tokenization of traditionally illiquid assets. Some amazing numbers that we can go by is like, what we have seen is, almost about 4 billion today is locked in DeFi protocols. And it's a small number compared to traditional assets, but it's still significant triple-digit growth, not double, but triple-digit growth in the last 1 year. And the last thing I would say, which is realignment of financial infrastructure, including things like trading, custody, fund administration, all the things that sort of govern the assets. So RWA is, mainstream at the moment. A lot of narratives that are emerging, not to mention the fact that with the rise of Bitcoin now, it's the fifth largest asset class after gold and NVIDIA and Apple and so on and so forth from that perspective. So super exciting times, I'd say.
Oh yeah, for sure. And I mean that's quite a stat about Bitcoin. What do you think of Robinhood's new venture?
So what's interesting about the Robinhoods and many of the existing broker dealers who are involved in the space is piggybacking on that narrative. So first thing was, of course, BlackRock and Franklin Templeton, WisdomTree, Fidelity. They all had some offering of an ETF or ETF-like product. BlackRock went as far as integrating this into its Aladdin, which is its risk platform that's available to all investment and large asset managers in the world, simply providing access to these things. What Robinhood did is saying, can we not take existing? So right now you have these wrappers or ETFs, or in some cases, stable coins or tokenized money market funds hyper liquid assets, providing the narrative of programmability, providing accessibility and sort of mobility of these assets in a much more efficient manner, things like collateral management and all these different things, which are sort of table stakes in the larger high finance, which is the Wall Streets and the large financial market infrastructure. And so where the likes of Robinhood came about, and this has been spewing actually from quite some time. If you remember, Stuart, a protocol called Mirror Protocol. This is prior to the Terra Luna fiasco that we had. The thinking was, can we not tokenize securities? These are stocks of Apple and Tesla and so on and so forth. So there's one public issuance of these equities. When you tokenize them, then you then piggyback on all the efficiencies that we've been talking about, both in terms of speed, resiliency, liquidity, and everything else. And then there's another narrative where you have all these companies like OpenAI, for example, or SpaceX. They are large companies, but they're not exactly public yet. It's access to these is still confined to a limited few. You have to be a accredited investor, or you have to be a qualified investor, or you have to go through a separate entity that has to vet you. So it's still a very walled garden type scenario. And where Robinhood came and said, while we still have to get all kinds of regulatory clearance for, let's say, tokenizing an Apple stock or an IBM stock, which are publicly sort of listed securities, can we not go after this space, which is the likes of SpaceX and OpenAI, which are very large companies, very large market cap, but not exactly public markets yet. And of course, Vlad Tenev announced that, and quickly he circled back and said these are the non-equities because they represent a tokenized sort of stock, so they become like derivatives, and they had to quickly walk back that whole element. But I think it's an important consideration because, believe it or not, the market cap of these private securities that are not listed on exchanges and not easily available is 4x. The private market is 4x of 4 times than the listed public securities, which is a trend that we've been seeing for quite some time. So it's a significant sort of movement. And I'll say one more thing, and I'll pause, and then I'll pause, is that when the securities are offered outside of the United States, then they go to something called a GDR, which is something called as a global depository receipt, which says that, hey, you have access to IBM stock, but you have to go through a wrapper of sorts to make it available for investment managers and investors outside the US. And because that's already a wrapper, many of these are already offered in tokenized form outside of the United States. So it's an easier offering outside the United States, which is where the likes of, Charles Schwab, the likes of, Robinhood have sort of begun to make that offering. And to me, it's a significant directional trend of the industry that we should pay attention to, and we should stay relevant to addressing that directional trend, if that makes sense.
Yeah, I mean, at Cannes, it was the kind of thing we were first getting there. I was getting ready for my talk and, helping set up the booth and generally just focus on Kadena. And I kind of regretted it. There was some airdrops of those tokens because Robinhood was, that's where they made, and I was like, wait, I want some SpaceX and some OpenAI, but then it was too late by then. It was already like a couple of days in, just because it's interesting. I mean, I wouldn't do anything with it. It'd just be kind of cool. But another thing, one of the reasons I brought up Robinhood is to bring up something that you and I have talked about, which is that they launched a chain on I believe it's on Arbitrum's ecosystem, where they're launching their own L2. So this gets into the some of the things that I know you've been talking about in terms of the rise of what you call de novo entities, and the replatforming of finance. Just in the sense you have Franklin Templeton launching on Stellar. So, for me, the interesting thing about this is that some of this really is, since they're launching on L2, we're really looking at a reworking of the app chain narrative. And that's something where I think Kadena is really positioned to offer something different, as you know. In the sense that we can offer a lot of the benefits that come from an app chain without the fragmentation that accompanies like launching your own L2 and things like that. So I just wanted to kind of just give the floor to you to talk about the whole app, how the app chain thesis is working with traditional finance these days, and why something like Kadena could address some of the shortcomings of that approach.
Yeah, absolutely. And I think this is a brilliant question, and please bear with me for the audiences just to hang in there, because I've spent so much time in trying to understand the movement of liquidity, and we'll spend some time on that as well.
That's why I
So
brought
I
you
use
here.
the word.
You're the guy.
Thank you, Stu. And so when I say the rise of de novo entities and replatforming of finance, you begin to see a lot of new players who have come into market, which were not traditional financial institutions. So of course, BlackRock, Franklin Templeton, WisdomTree, Fidelity, ARK Investment, these were all traditional financial investment, have very progressive thinking and say we need to, one, understand, appreciate, legitimize these asset classes and move forward with it. And they've done a fantastic job for us and the industry in creating the demand and providing some wrapper around the fact that if regulators are concerned around it. And then you have the likes of Maple Finance, the Centrifuge, the Clearpool, the super states of the world, who are de novo entities, including Ondo Finance, for example, who have said, why can't we build a model, which is what we have been envisioning for almost 14 years now, Stu, and you were there early on when you actually launched Kadena, is the convergence of the fact that you have crypto and digital asset as a new asset class, but then you also have, when I use the word replatforming, is modernization of financial infrastructure, is can we address the elements of trade trust ownership and bring them into this modernized financial infrastructure and removing some of the challenges of the old infrastructure from that perspective. And so all these de novo entities, and if you look at Coinbase, they launched a layer 2 on Optimism, which is Base. You have Robinhood that took Arbitrum and launched their own sort of chain. So a few things, right? One is there are still regulations in this space that requires you to adhere to things like resiliency and security of the infrastructure, which means you have to guarantee the government that things are going to be available all the time. And it's very hard to guarantee with this under the moniker of decentralized finance or decentralized infrastructure. So having a layer 2 that you control, that you manage, that you sort of build that whole structure. So that's one sort of attribute that to appease the global body of regulators to say, just like if you look at any of the JPM's infrastructure, Kinesis, which is their infrastructure, or what DTCC would do in the with their infrastructure, there are requirement of the infrastructure itself with things like good control location, ensuring that you have the right cybersecurity measures, and all these check boxes that you have to maintain. And many of these de novo entities who are coming to say, can we do this, are saying we're going to have our own sort of fenced infrastructure, and be able to launch all these new products, new financial structures, new financial products on these chains, giving these layer 2s some sense of not just volume, but also leveraging some of the technical capabilities of these volumes. So now what's that done is that's led to the fact that if I'm launching these asset classes, or broadly speaking, the industry has cash equivalent assets, which is quite rampant in the industry, and we'll spend some time on that. You have stock and equities, you have bonds and debt instruments, and then you have something called private markets, which encompasses everything that's not these 3 different asset classes. They all have their own requirements of freezing and forfeiture and things like how do the assets behave. And that has led to leading the growth of app chains. App chains are saying, okay, we're going to have application specific chains. So this chain has enough of applications, have enough attributes, they have enough characteristics that can handle a specific asset class, and that way people can launch their products and asset classes that adhere to that specific requirement of that asset. And app chain was being discussed for almost a decade now. It's come to fruition for many purposes, and this is one of the reasons why that's the case. Now, having said all this, what I want the audience to understand is there is something called liquidity, which is such an important construct in not just traditional finance, but crypto finance as well. And liquidity essentially means that you have enough of something that you can use a fungible instrument to trade. It doesn't change the value of a specific asset. And US dollar is that fungible instrument in traditional finance. And for example, Apple and IBM stocks are quite liquid assets where you can buy and sell these assets, but they don't inherently change the price of those assets with these large volumes of trade that happen. And what the industry has done in the last, I would say, 3 years, and again, the triple-digit growth I was talking about, was they have taken the traditional liquid assets in the industry, things like stablecoin, which represent digital cash equivalents, tokenized T-bills, which is for instant settlements and short duration assets, tokenized money market funds, tokenized treasuries, and tokenized credit. And that collectively today is about $340 billion and growing exponentially. And what this does, these tokenized assets, is provide the shock absorbing capabilities to not just crypto asset markets, Again, Bitcoin is now the 5th largest asset class in the world, but it also provides a convergence avenue between those two. Now, why am I saying all this, and why is Kadena important? So if you look at what you guys have done and what, I've been following this for quite some time, the chain web, the braided architecture, allowing for the best of both worlds. That what layer 2 did for Ethereum was it created all kinds of problems, that it created fragmentation of liquidity, that every layer 2 had some money somewhere, and it was a pain to move liquidity from one layer to another layer 2. There was at 1.17 layer 2s, and it also fragmented the infrastructure, where what you have done with this braided architecture is having a single point for security, which is your consensus mechanism, and giving the ability to create this namespace without having this sort of fenced architecture or having multiple chains. And conceivably, these chains could be allocated for these app chain infrastructures, but you still rely on a single security architecture, which at the end of the day, I think that this long-standing issue of this scalability trilemma, which is providing scalability and security and decentralization without the need of any rollups or sharding or complex bridges and everything else, I think Chainweb, or this braided architecture that we've been talking about, it really solves the problem. That we could envision a chain for securities, we can envision a sort of a chain for equities and a chain for liquidity. And you don't have to go through this complex and more risky avenues to connect them all together, because inherently the chain web and the Kadena architecture provides that connectivity. The question now is, can we recruit, and I'm going to ask you this question, Stuart, can we recruit enough ecosystem players to have ecosystem depth to bring all that innovation to our chain, to have adequate liquidity from this perspective? And what is our institutional playbook that allows us to be able to begin to recruit the BlackRocks and the Frankel Temples and the Wisdom Trees of the world to come to the party and say, we see this as a viable infrastructure because it allows us to adhere to all the regulatory challenges, which is what Robinhood is doing. And there's enough liquidity that suddenly now, by offering these new financial products, I'm able to attract talent, capital, and so on and so forth. So I'll pause here, Stu. I know it's a long-winded response, but I just want you to, there's a lot of depth in that question that you asked.
Yeah, I wanted to drill in on one thing there just quickly, and then we'll get to how Kadena's tackling this, because there's a lot of interesting stuff, both with Pact and with EVM. But you said one of the things is kind of like availability, resilience, and uptime being part of the app chain story. I hadn't heard that, so that's something. I guess if I was to interpret that without guess at what that's responding to, is the fact that Ethereum is a very stable environment. Bitcoin is a very stable environment. I mean, the uptime there is over the years is really tremendous. I think when they talk about like availability, my guess is that they're talking about controlling congestion. Is that the case? Because like making sure a public layer 1 has uptime is the same no matter where you go, right? They can't innovate on that. It's not like the Robinhood Arbitrum L2 is going to be more stable than Arbitrum's L2, right?
Yeah.
So,
no, it's a valid question. So to finish your thought, Stu. Sorry.
No, I wanted to ask you. I just wanted to drill in specifically on that. Like, what is the differentiation? Is it really just congestion, or is it some kind of like ISO certification of uptime?
Yeah, there is a certification process where, like, for example, if you look at, there's something called good control location. So I'll give you an example. When I build a private equity marketplace for Northern Trust, and this is all public information, and after we released that, the news, I got a 300 questionnaire from FFIEC. So one imperative from the regulators, and there's a college of regulators, which is like an alphabet soup of all kind of regulators, but US Treasury has a requirement in that any financial infrastructure, if the economy begins to depend upon it, so like payment infrastructure, for example, or our stock markets and equity sort of stuff, then it going down can have economic impact. So, for example, there was a scenario in UK when their main payment system was down for a day. Imagine a scenario where the world, which is increasingly digitized, and we, with our blockchain and digital assets, are taking this to a whole new level. If the payment system is down for a day, imagine you unable to swipe your card or pay for things, and you have to go back to cash. And many countries now have sort of moved away from cash. Many stores don't accept cash, your airlines don't accept cash, and so on and so forth. And so one requirement is to ensure the continuity, the business continuity of these financial systems, because it has a long-lasting impact on not just the economy, but our daily lives, because we had to buy medicines and bread and food and a drink every now and then. And so one requirement from the regulators is to make sure that if you're a market participant, if you are an entity that's involving and engaging in maintaining the financial infrastructure, you're providing those guarantees, making investments, and there's something called 5 9s requirement, availability of this infrastructure. And 5 9s is essentially a 5 minutes worth of downtime, unscheduled downtime on a yearly basis. So in a year, you can only have 5 minutes of downtime. And for that, a lot of these companies go through having, 3 parallel infrastructures, and now in cloud environment, but back in the day, they would have this infrastructure in their own data centers and make this massive investments, get certification, do annual testing to make sure that these systems are never down. I think that's the requirement of the uptime. Is in a decentralized world, where does this go? And so again, in the context of my past work, I was asked when I was at IBM, as you build in this infrastructure, that even the tech companies are regulated in some cases to make sure that they're testing these things in a prescribed fashion from the regulators. And when we do this testing, one thing that stood out for us to participate in this decentralized infrastructure is, do we have enough nodes that provides a verification, validation, consensus mechanism that even if the remaining nodes are not available, there's adequate quorum of nodes that are available to provide consensus and provide resiliency. And that's where I think some of the conversation with Base, which is Coinbase's architecture or infrastructure, or Arbitrum's sort of layer 2 of Robinhood, is to say, we will assure the regulators that even if some nodes go down, we have adequate nodes to continue transactions, and we are going to adhere to those regulatory requirements. So I'll pause here again, Stu, and that's what I think they mean by uptime.
Yeah, and that's actually, I think, a real strength, obviously, of public blockchain is at least, ones that are architected correctly using real consensus models, is the fact that, they can handle, so if Robinhood wants to, run 30 additional Arbitrum nodes, that's fine. That's just not a problem.
Yeah.
And then obviously with proof of work, that's even more straightforward. So okay, so I think that's a strength then of public blockchain, is the fact that you can, one of the things we worked on when we were doing private blockchain was trying to have a technology that could support. At the time we were shooting, we had tests showing we could do 2,000 transactions per second on 500 nodes, and that was completely unmatched at the time in private blockchain. But we felt that node count was one of the most important things, and it was for that resilience. It was so that, so it really meant that each individual participant in a consortium, we'd always think of them running 3 nodes. And then if you had 30 businesses participating and they're all running 3 nodes, well, now we're up to 90 nodes. And you look at some of the old private infrastructures, they really couldn't handle more than a handful of nodes, and they'd start slowing down. So that's a huge strength of public blockchain. So I'm glad to dive into that and hear about that. But getting back to, you're asking how Kadena is going after this, and you're right that institutional, that going after the institutional market is not just as simple as offering the right technology. And, we have a lot of depth in Kadena from the point of view of our backgrounds. I'm from JP Morgan. Annalise Osborne has worked on a million different things. Arca, we've Caesar coming from, just lots of background there, and advisors like you. And then, all the technical affordances that we've touched on already, but that's not enough. You have to have a thriving ecosystem. You have to have developers. You have to have TVL. This is an interesting discussion for us right now because we have really exciting stuff launching on Pact. We have everything from DEX to lending to stables. But we also at EthCC launched our testnet with over 50 partners coming on board in every part of, that are filling out every part of this strategy. So I think what's interesting there is that, while on Pact, we find that there's a lot of stuff that is going to be directly attractive to institutional use cases and players, in the sense that Pact offers all these advanced things in everything from custody to formal verification. Um, EVM is obviously, as our testnet effort shows, from an ecosystem point of view, is kind of a no-brainer in terms of like how to supercharge the amount of activity on the Kadena blockchain. So the interesting piece that is starting to come together now is institutional adoption on the Kadena EVM blockchain. And the reason why I bring that up is because all of these are going very well from a business development and business origination point of view. But some of the things that we take for granted in Pact, like gas stations and things like that, are only now starting to actually make sense in EVM with Pectra coming along. So this is something where we are, we're identifying kind of key partners to work with to bring some of these affordances to EVM, but there's still just some stuff that's missing, and that is going to be hard to replicate from the Pact point of view. I mean, just the fact that Pact has secure multisig. I don't know if you were aware of the Bybit, the
Yep.
issue with the safe wallet. I mean, that shows you what happens when you have multisig being handled by something other than the chain itself. It opens you up to attack vectors that are simply impossible in something like Pact. So it's an interesting tension, because we're bringing one of the reasons why we're able to do this is because of our experience launching and running Pact and understanding how our multi-chain protocol works under load, and all the kinds of, the things that make it kind of confusing or things that make it great. These are the kinds of things that we're going to be addressing head on as we bring EVM projects on. But just wanted to get your thoughts on how all of these play into the L1 narrative, and also just to touch a little more on the layer one narrative too, because like there's app chains and there's layer ones. How is this offering going to play with the institutional when they come and see the depth of our offering, and how it works in a kind of traditional layer one story as opposed to an app chain?
Yeah. No, I think that's brilliant, Stu. So a few things, right? One is, I remember 3 or 4 years back, I myself wrote a long paper on layer 1, layer 2, layer 3, layer 4, and we had this long narrative of all these layers that make this sort of a new OSI model, which is the open system architecture of TCP/IP, to say, hey, the existing internet is built on TCP/IP. We need to have a equivalent layered model for the value web, which is what Web3 is all about, right? And I think I would say that in the last few years, the focus now has been, can we compress these into a layer 1 to simplify the architecture and design, which is what Kadena has done, and I'll dive deeper into it. Second thing is that we've seen largely a business problem, liquidity fragmentation, security challenges with having all these multiple layer 2s and keeping up. At one point, you have to have a PhD in Ethereum to understand the Ethereum ecosystem, and that further complicated what is meant to simplify our financial infrastructure, and that was a problem. And then came about the likes of Mantra and the likes of Plume, who says, you know what, we are the chain for RWA, which is real world assets, and we'll only focus on that, which means that we will take all the characteristics that we define, which is scale, privacy preservation, and ensuring that you have fractional visibility of information data only to the participants who need it, because that's how the real world works today from taking the existing asset classes. And then came about the likes of Ondo announcing their own chain, Uniswap announcing their own chain, partly because they realized there's, of course, a lot of value in having the layer 1. The technology cost has become a lot lower than what it used to be, Stu, when you started this whole journey. But the thinking around the core elements of linear scalability, around maintaining a shared security model, because at the end of the day, if you're proposing a layer 1 design, which is the primary transactional infrastructure, you have to make sure that you can't screw that one up, in the sense that if the layer 1 itself either falls on its face because it's not scalable or is inherently insecure in its transaction processing, you're sort of breaking the entire scaffolding of all these applications, whether it's a decentralized exchange or whether it's a lending pool or it's any of the Aave and Uniswaps of the world who are building these financial structures. You're risking the entire sort of edifice of this new re-platforming of finance, as I've labeled it, right? So from that perspective, the motivations behind a lot of layer one is fine. We have our own token. We manage our own treasury. It gives us tremendous flexibility. But does it really solve the problem of having yet another layer one with some specialization? And I think what you've done, to me, I look at four things that Kadena, to me, from a RWA perspective, is this chain web architecture, the braided parallel chains, solves the issue of scalability, allows me to be able to spin up multiple chains while still maintaining that shared security model, which means I'm still tethered to this robust proof of work, which is still, I mean, the reason why Bitcoin is what Bitcoin is because of proof of work. And many of us still believe that you are inherently relying upon computational security as opposed to economic security, which is what proof of stake provides, right? And so to me, the chain web architecture is a brilliant model because I can then create this parallel processing and still tie to a shared security model backed by proof of work, which is still one of the most resilient security structure that's in the place. Second thing is the packed smart contract, the formal verification, the ability for me to upgrade the smart contract, which is such a vital thing because businesses are never static. They change, they have to be upgraded, and ability for us to be able to ensure. And if you look at digital asset, they launched their own Canton network. They have relied upon the something called zero knowledge smart contract, which again tries to provide security layer on smart contracts. I think all that is inherently built into the packed smart contracts. EVM compatibility, which was, I think, another brilliant move from the technical teams at Kadena, attracts the portability of code of an evolved ecosystem from the Ethereum world from that perspective. And having no gas PU for the end users, which is having gas stations, allows business to not deal with the nuances of the value fluctuations and dealing with keeping these assets on the balance sheet. They can still focus on businesses and not deal with. And the last thing I would say, the fact that you have this braided structure is I have the ability to have a hybrid private public model. Exactly what we're discussing in context of Robinhood is to spin up a chain, do all the work I need to do, and have privacy layers on top, whether I'm using advanced encryption or relying on some capability of zero knowledge proof to preserve privacy. And perhaps the question for you in this case, as I end this long narrative, Stu, is it a probability in future that we have, as we are spinning up this new parallel infrastructure for chains, can we have a privacy chain? Can we have chain that has built-in encryption or built-in zero knowledge, way of transacting with the participants involved in that chain? And that could actually bridge that gap from a regulation perspective. So I'll take a pause here and over back to you, Stu.
Yeah, no, that's definitely the hot topic in institutional adoption for sure. And Canton, recently doing, I think it was like $150 million raise. There's lots of stuff going on. Canton basically offers, something similar to what we were offering before in the sense of, in theory, a permission chain makes a lot of sense. For all the reasons why privacy is so important. Also, Vitalik has talked a lot about how privacy is the final frontier in the sense that we won't really be able to realize the promise of blockchain because it's not just for institutional, right? There's reasons why everyday crypto users should be entitled to privacy as well. But it's a hard topic because we're talking about new technology. We're talking about, in some cases, things like fully homomorphic encryption, which, as I understand, is usable for certain use cases, but like using it for like a stable coin is still a ways off, just in terms of like getting that to the point. The amount of compute required for some of these things, including, things like, ZK technologies. Coming online, Aztec and things like that. I mean, they're still in beta. They're still in testnet. So I think that what Kadena offers is, well, for starters, the chain, the idea of a privacy chain has two main components. One is that you can, in a public chain environment on Kadena, you can basically, Kadena has features such that you can make it that you can restrict what other applications you work with. I mean, one of the problems that came up with with something like BlackRock is that with Biddle is that you have these accounts that a problem in public chain is that anybody can airdrop to you. Once you have an Ethereum key, someone can just start dropping funds and associating it with your key. And this can create like big problems from a regulatory, from a custody point of view. And there's really no way to stop it. So that's an example of something that like a segregated chain could just completely eliminate, is it could say that, we're going to make it that, so this isn't, and just for the listeners to be aware of, this is something that we're discussing at Kadena. This is not something we are open to working with partners and seeing if something like this solves problems and makes business sense. So some of this is just kind of our initial outlook on that. However, I think the more immediate focus for us is on privacy technology in terms of, we have a partnership. We started a partnership with a company called Lurk, then called Argument, and they built an implementation of Succinct Labs SP1 that works on Kadena, and that's something that we're readying for production. Initially the idea was to use it for a bridge, but now we're realizing that some of that stuff has capability in a privacy use case. But I think the idea is that there are other technologies too out there, like trusted execution environments that give a comfort level for a kind of circle style direct mint on chain use case. You can put that inside of a TEE very easily. So, so in a way, I think it's kind of the march to production of these privacy technologies being kind of a core piece of how institutional will be able to bring, all the business that they really want to bring on chain. But I do still see it as tomorrow tech in the sense that there's a tension between having a public chain, which, part of the trust of a public chain is also being able to trust the transactions that happen on the chain. Some of these approaches to privacy reduce the chain basically to a timestamper. And I think that's even what Canton does they have their public synchronizer. So that's offering such a small amount of trust from the public chain. I don't think it really gets there ultimately. Although, bridge technologies, things that'll get us started and get people minting on chain, we're happy to partner with people. But I think the more interesting thing is when we start seeing, kind of the promise of something like you can do with Succinct Labs, where you have a whole ZKVM running, and you actually have, you have full transactions happening in this cloaked environment that is, where all of the details that you need to emerge from the transaction and so it's beyond just timestamping, because timestamping, typically is just like a Bitcoin, what they used to call colored coins, in the sense that you're just throwing a hash up there and saying, well, it's, this hash relates to the stuff we did on this offline system, and it means nothing to the people that are on the chain. And to my mind, that's just insufficient. Whereas with something like having a full VM and the proper proving environment, it means that you can unmask inputs and outputs as needed to provide kind of a greater level of assurance, in the sense that you might not want to have things like balances and transaction amounts, but you can have things like total supply. You can have things like, you can be talking about the different currencies that are in play, and maybe even, I would imagine that in certain use cases, making it possible for regulators to crack that kind of thing open. To me, I don't know if you agree with that, but that's where I think things have to go for this kind of public chain privacy story to, one, give institutions the comfort level they need, but two, preserve the trust that is beyond just the fact that you can trust in the consensus, but that you can actually trust in the transaction and the business, because enough things are verifiable on chain. Do you agree with that?
Yeah, I do. And I would say one more thing, right, Stu? I think the technical description of what you mentioned is spot on, right? We need to do these things. But like 3 weeks back, I began to spend some time like we have all these protocols and all these different chains, like 800 plus different chains that are vying for the attention of the industry in general. I began to look into say, where is the real liquidity here? So besides the Bitcoin and Ether, where is the liquidity that is induced by us, by not crypto economic systems, but by stable coins and tokenized T-bills and everything else? So in that context, I looked into, besides having these raw technical areas, whether you're looking at the smorgasbord of the privacy technology available to us, tokens, there were some token standards like ERC 1400, ERC 3643, and a bunch of these things, which allow for the users to go and build these applications that then leverage the underlying security technologies to say, I want to enable permissioning, I want to enable KYC rules, I want to enable off-chain data integration, because, one, it's practically impossible, nor it's feasible, nor advisable to put all your data on one chain. It creates a scalability challenge. And so you do need to get off things like market data, things like KYC data. I can't pack everything to one chain. Even if Succinct Lab does a few things, it's still tied to the limited amount of information that you're trying to send across that whole thing. So this whole composability element, which means that we have to either join that band somehow and absorb that standard that has been sort of universally accepted by at least the de novo entities that we talked about, and bring them in-house to say, hey, we will adhere to these standards, which means those standards are then packed ready that we can do these things. Second thing I would say, which is what Pact already does, is composability. So I looked into, broadly speaking, there are 3 chains today, essentially Optimism, Arbitrum, which is Ethereum sort of offshoot, and Solana. And surprisingly, I saw ZK Sync, and there are practically 2 protocols where all the liquidity moves through it. So amongst all these different chains, you have just those 3 chains, and that's just the value, the attribute of these sort of standards that somebody has proposed. And largely speaking, all these DeFi protocols, all the liquidity passes through Uniswap and Aave, which happen to be in all these different chains. So Uniswap, again, is, so I think our focus from Kadena's growth perspective is, I said, technology is great, but I need to focus on liquidity, because that's where all the businesses come. And you will then begin to see all these new structures like decentralized exchange or lending protocols and borrowing protocols or collateral protocols will begin to form, because these businesses will go, the gravity of that will only move towards where the liquidity is. And so that's where my thinking is, that besides the core technical element that you described eloquently, Stu, is embarking on some of to say, hey, how can I bring in these institutions, because they are used to a specification, because that's how they operate, and me not fighting it and saying, let me slap that on my Pact smart contracts and be ready to accept that business, so to speak.
Yeah, and just one last thought about that, which is that it's so obvious from an ecosystem point of view the advantages of integrating EVM into Chainweb, but the one that's a little subtler is that one of the real reasons we did this is, as we started approaching institutions, one of the big reasons why they would ask about EVM was one, for developers, but also because of participating in these standards. Because of course we can, we have a really great RWA standard in Pact, and we're, and Curve Block and other, great partners are getting their hands dirty firing that up, and that's great. But, there's too many, you don't want to reinvent everything, right? I mean, there are good models for that, of course. I mean, you and I have talked about like Solana and how they, brought out a lot, a very strong portfolio of. But at the end of the day, it's like you say, you don't want to fight these standards. You want to embrace them. And that's actually one of the big reasons why we did EVM, is so that we can be part of these standards, and so we can help strengthen them and even weigh in on, start being a stakeholder in how these standards move forward, especially in light of having something different than other EVM like in terms of like what we can offer in terms of having the multi-chain protocol and what that means for scalability and resilience and all those kinds of things. So, I mean, it's a really good point, and it's a subtler point of why we went to EVM. And the other side being, of course, that, it just increases the amount of partners we're bringing in from the TVL side. And that being really central for Kadena as well. So, well, it's been really great having you on here, Nitin, as I knew it would be. It's just so much fun talking to you. It's always like, I hope people have enjoyed it because really, this is the kind of perspective that that I'm really glad to give our community some access to. Thank you everyone for joining us. We hope these spaces are useful in providing a recap of our progress and getting deep into some of these topics. And so check out our 2025 roadmap page. That's at kadena.io roadmap. Of course, follow us on Twitter right here to stay up to date, engage with our community in Telegram, and join our Discord for technical support. And lastly, if you're interested in our new Chainweb EVM testnet, check out the EVM developer portal at evm.kadena.io and get more info about our $50 million grant program at kadena.io/grants. So once again, thanks so much, Nitin.
Thank you so much, Stu. I'm super excited about the future. I've seen this grow since I joined this team, and I think the advances the team have made is super exciting. So I'm, again, rooting for it, as I should. And more importantly, I think I'm excited about the technical features that is going to enable the new generation of finance going forward. So thank you for having me. I love this chat as well.
Fantastic. All right. Thanks, everybody. We'll be signing off, and we'll see you at the next Kadena News.